Okay, today we're going to talk about cash and sales receipts. So we're going to identify revenue that's going to come into a merchandising business, and we're going to learn how to journalize it, and we're going to learn about some new accounts. So that chart of accounts you've seen before is going to be expanded. We're going to add some new ones, one of which we've talked about, which is sales, a revenue account with a credit balance. However, let's talk about something called retailers. Who are retailers? People who sell stuff. So can you give me an example of a retailer here? Yes, Toys R Us, Walmart, all those that buy from other people for their product and then in turn sell it to another group of people. What is the difference between a reseller and a wholesaler? Yes. Does a wholesaler make a profit? Okay. Okay. So what would be an example of a wholesaler? Costco, wholesaler. Not doing it through a middleman, but doing it directly to the consumer, which is why supposedly the prices are lower. But oftentimes, yes, unlike many wholesalers, you do have to buy in more volume because that's how they get the reduced prices for you, buying in volume. So if that works for you, it is a savings. If you don't need the bigger volume, it is not a savings to you. Now, there's going to be different kinds of sales that we're going to talk about, just like we did before, cash sales and credit sales. So you're going to have customers paying cash and customers buying on account. Whenever a customer buys on account, what account is affected? Accounts receivable. We're going to receive funds that's of value to us as a payment in the future. So if cash sales were 1,000 and charge sales were 2,000 for the day for this business, tell me what the impact would be. Cash sales 1,000, credit sales 2,000. Anastasia? Okay. There are $3,000 total in sales. Doesn't matter if it's charge or cash, they both fall under the revenue account sales. So sales gets credited for $3,000, correct? What is the debit for that transaction? Good. $1,000 to cash and $2,000 to accounts receivable. Make sense? Are our debits equaling our credits? Yes. If you add up both debits, they equal the one credit to sales. So it does matter the method of payment for recording these transactions. Again, the sales account is a revenue account with a credit balance. In which financial statement does it occur on? Income statement. Income statement. Does it occur on anything else? Any other financial statement? Nope, just income statement. Is it a temporary or permanent account? Temporary, because revenue accounts are temporary. Those that show on the income statement are temporary accounts, meaning we're going to close them out at the end of a period and we're going to update our capital to reflect the loss or the gain from revenue. Now, here's an example of a sales invoice. This would be a source document for a sale for your company, showing the product, the person, etc. There's some information on it, specifically right down here, that shows some credit terms. Those credit terms are something we're going to talk about here in a minute. So for right now, just take note of where they're at. And the fact that credit terms are information only until the amount is paid. Okay? Information only until it's paid. What credit terms do is allow a discount if you do prompt payment within a certain period of time. What happens if you don't pay within that period of time? No discount. So therefore, again, it's information until it's paid. So, again, here's going to be another change in entering information into the journal. Take a look here. Accounts receivable, whenever we get a sale of merchandise for credit, accounts receivable gets debited. But from now on, you're going to have a dual entry. Not only do you put it into accounts receivable, but into the person's name that bought this product. So for this one, we're going to put Walther, because that is who bought this product. So look over in the post-reference column. What do you see? A slash mark. Is that there? No. But you're going to put it there. Every time you see accounts receivable in a journal entry, in the post-reference column, you're going to put a slash. That's a reminder to you that when you post both to the accounts receivable account in the general ledger and to something called the accounts receivable subsidiary ledger. And that's where you'll find this customer's name. So let's talk for a minute then about accounts receivable subsidiary ledger. What is that? What is it? Good, exactly. She's saying it's a breakdown of our accounts receivable. So in other words, it's a book or some method of recording that lists all your customers and all of the transactions that affect their balances. So every time they buy, you're going to have to record it to their account. Why? Why is this crucial? Yeah. So what if they call you 2 weeks from today and say, what's my balance? And you go, well, let me go back and add up your journal entries. No. You have to keep that running balance at all times, which is why you not only have to affect the general ledger account, but also the subsidiary ledger account for each customer. So in the post-reference column there, I'd put the account number for accounts receivable, correct? Once I post it. And that would start with a 1. And then what am I going to put when I post to the subsidiary ledger for Walther? Just a check mark, indicating this has been posted to the subsidiary ledger for this customer. A check mark, only a check mark there. So for that debit for $1,240, I need to post 2 places. And then the credit goes to just the sales account itself. Okay, is that clear for everyone? Anyone question? Okay. Now, subsidiary ledgers can be added to at any time when customers come in. If you have new charge customers, you're going to add a new account to it. They're usually listed alphabetically. They could be listed by account numbers, but make it some way that's easy for you to find the various customers as they make their charges and or their payments, because we're going to record payments in them also. And that's something we'll do in the next chapter, is recording payments. Now, here's a term we haven't talked about before. It's going to come up for the first time, and it's called a controlling account. And look what's identified as a controlling account. Accounts receivable. It's called a controlling account because it controls the subsidiary ledger for all the customers. So the accounts receivable subsidiary ledger, if you were to add up the balances for all the customers, it should equal the balance in accounts receivable. And that is a check for you as a business. If the balances in all my customer accounts equal my accounts receivable balance, then I must have done things correctly. Everything must be recorded. But if it's off, I need to go back and find out where I went wrong. Either a computation, an error recording a sale, or a payment. Something went wrong somewhere. But again, it's a controlling account. So look down at J. Walther. See the T account up there? So it's got a debit and a credit. So what's the balance for J. Walther? Zero. Meredith only has 1, and Adams only has 1. So if you were to add up the balances in all those subsidiary accounts, what is the balance? 4,300. What is the balance in accounts receivable general ledger account? 4,300. So again, controlling account for the subsidiary accounts. Here is a new account. It's called Sales Return and Allowance. And what is this used for? Whenever a customer returns merchandise to you, we're going to use this account. Now, it is specifically related to the revenue account sales. Therefore, it is called a contra account. So by definition, a contra account must have the opposite balance. So therefore, sales return and allowance is going to have what kind of a balance? A debit. So every time we want to have a return, it's going to be a debit to sales return and allowance. A debit. We're not going to directly affect the sales account. Instead, we're going to keep track of all returns in the returns and allowance account. Why would we do that? Why not just reduce sales? Because that's really what's happening. Why would a business keep this account? Okay. To show how much of it's been reduced due to returns from customers or credit given because of defective merchandise. So it's just a way of tracking that information. So for example, if Smith returns a product valued at $50, the impact would be sales return and allowance for $50 and accounts receivable credit for $50, reducing accounts receivable and reducing Smith's account also.
What if you paid cash on his receipt?
If you paid cash on it, you're just giving cash back, so receivables isn't impacted, it's just cash. So the credit would go to cash. So if it wasn't on account, but it would still be a sales return and allowance.
So it would be on accounts receivable and then also on his account, this would be?
No. If it was a cash purchase, there wouldn't be anything under accounts receivable initially. Oh, yes. This would be both, correct.
You go into the subsidiary account as well.
Yeah. So it's to the general ledger account, accounts receivable, and to the subsidiary ledger for that customer. So here's a journal entry example. Sales return and allowance, $50. Accounts receivable, Smith, $50. Both postings for that credit to the general ledger accounts receivable account and to Smith, located in our subsidiary ledger for accounts receivable. So under post reference for that one, what are you going to put? A slash, indicating 2 postings necessary. Now here's another new account. called a sales discount. And we saw the terms back on that invoice we saw earlier. It's another contra account. It's directly connected to sales. Therefore, what kind of a balance will it have? A debit. Sales is a credit. Contra accounts have to be opposite. Therefore, sales is going to be a debit balance account. Now, remember those credit terms on that invoice? Let's look at an example here. If the terms given for a credit purchase are 210 N or net 30, what does that mean? Good. If you pay, or the customer pays within 10 days, they get a 2% discount. However, if they don't pay within 10 days, the full amount still needs to be paid within 30. And that is information only until it's paid. So no discount will be given unless that invoice is paid within 10 days. And 10 days of the date of the invoice. Now, other things you might see are something called N/EOM, which means the net is due by the end of the month. So whatever date is on the invoice, it's the end of that month. What happens if you don't pay by the end of the month or by the 30 days? Oftentimes they'll charge you finance charges. So what if my terms were this? 115 N60. What does that mean? 115 N60. 1% discount if paid within 15 days, or the net is due in 60 days from the date of the invoice. Okay, everybody clear on that? Yay. Here's a journal entry for a sales discount. Jerome Wather pays Terrence Home Improvement Store within 10 days for invoice in amount of $936 for terms of 210 net 30. Prepare the journal entry. Now think about this. The sale was $936, and how much discount will this person get? 2%. What's 2% of $936? $18.72. Not a big amount, but just think. If you did that for every invoice when you were buying, then you'd get quite a significant discount. So the debit goes to sales discount for $18.72, or 2% of the invoice amount. And then we're going to also get cash from them, correct? For the difference between the invoice amount and the discount, or the amount of $917.28. And then accounts receivable and the customer's name in the subsidiary ledger get credited for the full amount of the invoice because we want to wipe out their balance. So $936. Always check, do our debits equal our credits? If you add the cash to the discount, does it equal $936? Yeah. So that's how you know if they're computed correctly, if the debits equal the credits. And remember, you're always wanting to wipe out the balance in accounts receivable. So that's usually the full amount.
So why is there not a double entry on that one? With the little double box?
There would be. Always. When it's, let's go, should we go back to it?
Yeah, you didn't have a box on it.
Well, there's nothing in the post reference.
PR column.
Yeah, there's nothing there.
But wouldn't there be? No.
That's something for who's ever entering it to put there. Yeah. I just put the first one just to show you what it looks like. Now, do you have to put it there when you write in the account name? No. You can wait till you're actually posting. But I suggest doing it every time you journalize accounts receivable, because what does it remind you? I've got to post twice. Yeah. So I'd suggest always doing it right away. Now, remember that one I told you that was specific to some states and not ours, that we're still going to learn about? It's called sales tax. Sales tax payable is a new account. By definition, payable, it is a liability account. Therefore, it increases with a credit. Which financial statement would this be found on? Balance sheet. Liabilities. Good. It is a tax collected from customers, whether they be charge or cash customers. We're going to collect it from either one. So here's an example of a transaction. A $1,000 cash sale along with a $2,000 credit sale at a 6% tax rate. First of all, we just need to multiply times the rate to get the amount of the tax, and that's necessary. And then we have to add. Why have we done these separately, by the way? Why didn't I just do it for the total sale? Right. One of them is a cash receipt. So we're going to receive cash for part of it. So we're going to debit cash for the $1,000 plus the sales tax that we collected. Because whenever you have a cash sale, you have to collect the tax right then. How about accounts receivable? What are we going to show? 2120, good. The $2,000 charge purchase plus the tax that's associated with that $2,000, so 2120. And credits go to two accounts. Yeah, not for 90. 90, no, 120 from accounts receivable, the charge purchase, and the 60. So 180 goes to sales tax payable. It's a liability, which means it's a debt we've incurred as a result of this revenue, but we're going to have to pay it later. And sales, how much? Yeah, 3,000. Check it out. Do our debits equal our credits? 1,060 and 2120, 3180, and then 3180 for the others. So we are in balance. Now, do you remember your income statement before? What was on it? Revenue minus operating expenses gives you your net loss or net income. That's going to be changing now. For a merchandising business, our income statement is going to be much larger. So we're going to only introduce the first part of it right now, and in the upcoming chapters we'll expand on that. But before, our total revenue was just our revenue account, whatever it was going to be. We still have probably one revenue account, sometimes a couple, but there's things that will impact that revenue account, and those are the two contra accounts we learned about today. The first one is sales discount and sales return and allowance. So what you do is you take the balance in your sales account, your revenue account, and you subtract the discounts that were taken and the returns that customers made from that gross sales amount up here. And the net sales equals the difference between those. So if you take 1240 and subtract 1872 and 304, your net sales actually equal 917.28. So again, this is where we're reducing that amount shown in sales by taking those contra accounts away from it. Okay, Here's a quick review of the things that we've just gone through. Let's look at the first one and tell me what's happening without reading the explanation. 5,000 cash, and capital account gets credited for 5,000. That's from day one. It's an investment in the business. How about the next one? Cash debit and sales discount debit, and then accounts receivable credit. Someone paid on their account within the terms of their credit. So they pay within the discount period. Therefore, cash amount shows the reduction due to the discount. The discounts get recorded here, though, as a debit because it's a contra account, so it's a debit. And then accounts receivable gets credited for the full amount of the original sale. Now, the last one, what is that for? Cash sales, meaning we're just selling items and receiving cash for them. Nothing's been done on credit. Simply debiting cash and crediting sales. Make sense? Notice the dual entries are for which ones? Accounts receivable only. So accounts receivable, see the slash there? It gets posted to the accounts receivable account in the general ledger and to the subsidiary ledger for accounts receivable. Going to have to do that every single time from now forward. Now, one of the last things you can do to check the accuracy of your subsidiary ledger and your general ledger controlling account is to create something called a schedule of accounts receivable. And here's an example of one. It's literally just the company name, what it is, schedule of accounts receivable, and a date. And then you're going to list, and I'm going to repeat this, you're going to list those customers with balances only. If a customer doesn't have a balance, meaning they owe you nothing, you do not have to list them on this schedule. So you're going to go through your subsidiary ledger and list all the customers with balances, and you're going to total it up. That's all you do for the schedule, is just total up the balances. Now, what's your check figure for that? The accounts receivable controlling account in the general ledger should match that amount. If it doesn't, something is wrong, and that's where you need to go back and check it. Maybe you forgot to record a payment. Maybe you just computed something wrong on somebody's account. But this is a way to catch those mistakes before they go on. Do a schedule of accounts receivable. It's also a good thing to do just to show who owes you money. This many people owe us money, and this is how much they owe us.